G'day, fools. I'm the Motley Fool's Chief Investment Officer, Scott Phillips, and welcome to another in our Bulging Numbers of series. This one is our favourite investment books, where, surprise, surprise, we talk about our favourite investing books. And I have with me Benny O, one of the Motley Fool's gun analysts. Benny, g'day. How are you, mate?
I'm well, thanks. How you doing?
Very well, thank you, sir. I'm excited about this one because I've read some of the books the guys have talked about thus far. I've definitely read this one. It is one of my favorite investment books by a long, long way. It's one of those foundational, formative books that I think you can't unread, right? It's so impactful, it's so useful. I'm not going to steal all of your thunder. Suffice it to say, this is a really, really top book. Even before Benny summarizes why you should read it, I'm going to tell you should read it. Benny's going to tell you should read it, but more importantly, Benny's done the research here. I'm just here conducting traffic. Benny's going to tell you what it's about and why. The book is one up on Wall Street, Benny. I'll just start off with a bit of a. So Peter Lynch is the author. Have you prepared to talk about Peter or just the book, mate? Before I throw you in the deep end.
Both. I can start with Peter.
Beautiful. Let's do that.
Peter Lynch.
I won't cover it. Go for it.
Awesome. Yeah. So Peter Lynch is a fund manager, and so he wrote the book as well. But he's considered one of the most successful and well-known investors of all time. You're a big Buffett fan, so you'll probably say Buffett, but I think Peter Lynch is up there. But essentially, he was the manager of the Magellan Fund at Fidelity Investments, and that was between the years of 1977 to 1990. So spanning of those 13 years, at the start of his manager role, there was around, I think, $18 million in assets. By the time he ended, it grew to $14 billion in assets. So
that's more, right?
That just implies that a lot of people were wanting to give him money to invest for them. So over the 13 years, the fund averaged a return of, I think it was 29.2% annually. So that was beating the market and beating the S&P 500 11 out of the 13 years. So remarkable track record. But to put it in context, a $10,000 investment would have turned into $280,000. So quite impressive to me. Yeah.
Not bad in 13 years, mate. If you've gone away for a couple of years and come back to that, that'd be a nice place to end up. Of course, Lynch is spectacularly well known, a great fund manager in his own right. It's one of those things, none of what he wrote about would be any less important, relevant, or true had he not had that spectacular success. But there's something about success that reminds us we actually should pay more attention. So there's probably plenty of other would-be writers who've said even equally true things and never quite get the time of day. But when you're both right and you have that track record, it very much pays to listen. I am a massive Warren Buffett fan, but I am also a massive Peter Lynch fan. Some of his investing approaches and the way he codified his investing, and I know you'll talk about that in a minute, it's just been so impactful on so many of us. It kind of was, I would argue probably, and we won't get into details here, and you're a young man, Benny, but Phil Fisher, pre-Peter Lynch, was almost the kind of the connecting point between the old style, old Warren Buffett, deep value, net, cigar butt investing. You got the Peter Lynch, higher growth investing. Phil Fisher kind of sits in between there, but if you kind of trace that lineage, we should cover Fisher's book another day too. Lynch has had such an important impact on not only new investors and new investing styles, but the new sorts of companies that, even though Lynch was pre-internet, the sort of ideas he brought to bear and brought into play were just really, really important right through the following, 31 years and beyond since he stopped in his role managing the Magellan Fund. Very quickly too, we should say that's not the same as Australia's Magellan. So Magellan Funds Management, the Magellan Financial Group are not the same as the Magellan Fund that Lynch ran for Fidelity. So let's just move that out, just in case people get a little bit confused. We don't want you to connect the two accidentally. All right, mate, so enough of me talking. Tell us about the book.
Sure. So firstly, it's a great book, very easy to read, and it teaches you many investment lessons. I think one that pointed towards me was it shows you how you can invest with what you already know and actually win in the stock market. So he does this in a very simple way. So what I really liked about the book was that he articulated about certain investment ideas in very simple English terms. I think that really resonated with me, but it's also similar to what we do at the Motley Fool, which is to articulate complex ideas into simple layman terms. And so it's a really great book if you're a beginner investor, but even if you've gone through, I guess, a few years of investing, it'll teach you some lessons that you might have not picked up before. And I think I've read it twice now, and you just keep learning new things.
So cool, so cool. You mentioned, of course, the idea that us investors, average people, and look, the Motley Fool, as you say, is not only trying to make complex things as simple as we can, and no simpler, as maybe Einstein said, but also too the very idea that like we are investors writing for, investing alongside investors. The whole idea of the Motley Fool. I was a member of our community. I was a happy member of our US services, where we didn't even have an Australian business. So I've come from where many of our viewers are today. We're not necessarily endowed with superpowers just because we happen to be on the other side of the screen. And that idea of one up on Wall Street is Lynch's assertion that effectively not only can you do the same as Wall Street, or here we might just call it the professional investor class, not only can you match them, you can potentially beat them with some of those things, including, as you say, the things you already know. So many different terms, so many different approaches. I don't even know where to start. Just break down some of the components of the book for us.
Sure. I'll probably point towards some of the takeaways as well in conjunction. But
Yeah.
so I think one of the takeaways that I got from the book was that to invest in what you know. So I think he coined that very, very clearly. And so what that exactly means is that the average investor is exposed to interesting local companies on an everyday basis. So whether you go into a shopping mall, where you work, your hobbies, you'll find something that you might have a specialized knowledge or you understand the business trend about more than the professional investors do. That's not to discount that the professional investors, they may know this as well, but some of them may not. And those that do not might need to do extra research. And so Peter Lynch is just articulating that it's very important to look what you have and then use that as a lead. Don't just go with what you've seen. So for instance, if you go to the Starbucks and you like the coffee, don't just buy the shares in Starbucks. Use that as a lead.
That's right.
And then from there, you look at the company fundamentals. You look at the earnings. You look at the cash flows. And so that actually helps you understand the business. And when you truly understand the business, you can develop a story to monitor the progress of that.
I really like that summary, mate. I will say for myself, two of my better investments over the years, or two of my better recommendations for Motley Fool Share Advisor members, were Corporate Travel Management and Premier Investments. Corporate Travel I'd used when I worked at Blackmore's many years ago. We used it as our booking system. So I knew the system. I knew it was easy. I knew it was simple. When I joined the Motley Fool, I started looking around, and all of a sudden this company pops up. I'd used it. I knew it was good. I knew about how it worked. So that was a really nice lead, which led me to some good returns. Similarly, Premier Investments, way back in the day. My young bloke was 12 or 13. Smiggle, the stationery store, was just white hot with him and his mates and the girls at school and the whole. It was just one of those, and you're kind of like, wow, this thing is a real deal, right? And as you say, nothing to say that the professional investors couldn't have found those businesses. You do enough research, you can cover enough rocks. Eventually, maybe you find the same things. But as you say, that lead idea, the whole idea of like, man, people love this thing. Like, there must be something here. Let me try and find out what it is. It's also a good way, by the way, to avoid, as a professional investor in air quotes, you kind of say, well, it's stationary. How could it possibly, it couldn't be sustainable. It couldn't work. Why would people pay that much money? You can find lots of reasons to kind of spreadsheet it, to kind of discount the lived experience, right? The reality that we go through of that actually is popular, believe it or not. And I think sometimes we can, behind a screen, miss that. When you're actually out there living it, experiencing it, seeing it in the shops, it can have a really, really meaningful impact. All right, mate, let's go to another takeaway from the book.
Awesome, sure. So another takeaway, I think he paints this quite well, is that he's saying that if everyday investors may have an advantage over professional investors, because professional investors sometimes have certain rules and regulations that prevent them to make investments. So what he means in this kind of theme or topic is that ultimately professional investors, they're sometimes constrained to certain mandates or liquidity or particular restrictions. And so that prevents them to invest in things that are, I guess, a bit more exciting or in a more smaller cap land. So that kind of gives the average Joe a bit of advantage to allow them to invest in this space that professional investors cannot. And I think there was a famous quote that he mentioned in the book. That's, I think, part of Wall Street quote. You'll never lose your job losing your client's money on IBM. So
That's right.
That just goes to show that a lot of these professional investors, not all, but some, they tend to invest in the more mature, established companies. And so these companies may have lower risk, but generate profits. And so if you compare it to like a more fast grower, for instance, that's definitely higher risk, but it has potential to make larger profits. And so I think another key takeaway from that is that these professional investors, sometimes they have a bias to wanting to make investments where they may look bad.
Yeah, it's a really nice point too, mate. I think that's, IBM is the US example. Even the saying's been taken by a lot of industries. There was the old, the IT department would never get fired for buying IBM. If something goes wrong, if you buy IBM and something goes wrong, they'll say, oh, it's IBM. Like, who could have known? If you buy something else that's not IBM and it goes wrong, everyone says, you should have bought IBM. And so you think about career risk, as you rightly point out, those incentives, those biases, you're never going to get the sack buying shares in Woolies or buying shares in BHP because it's Woolies, it's BHP, right? And so you're right. When it comes to both the actual individual positions and also to if you vary too much from the index, if you're trying to follow an index and beat it by a little bit, you kind of want to own the index because if you lose, you lose by a little bit. If you win by a little bit, but that keeps your job. If you make outlandish big bets and some work and some don't, or even if there's just medium-term volatility or your thesis takes a while to play out, a fund manager's got 3 months, maybe 6 months for a thesis to play out before someone knocks on the door and says, I'd like my money back, please. And so you're right. Not only do we have the ability to look where they're not looking because of those mandates, we have the advantage of time. We're not governed by monthly, quarterly, 6 monthly performance reviews and performance stats. And I got to say, as much as we want to say, look, retail investors got it better than the fundies, it's kind of true, right? I don't envy the fund managers who have to every quarter show up and say, here's the numbers. Yes, here's what we did. I'm not surprised they end up index hugging just to try and make sure they don't, even with the best of intentions, the best of effort and research, end up with the wrong stocks, and all of a sudden, if you missed by 2, 3, 4%. I remember back in the day, the Afterpay was the most hated buy in the market because even those fund managers didn't want to own it, felt like they kind of had to because you couldn't get caught not owning Afterpay at some point because everyone did. If it went badly, well, everyone else owns Afterpay. If it goes well, at least you got the upside. But it was one of those companies that as soon as things went badly, fund managers would sell out in a heartbeat because they could finally say, thank goodness I'm out. I didn't really want to hold it anyway. I felt like I had to. So those things don't happen. I don't apply to individual investors. Anything else from the book that struck you?
I think the third and last one, I've combined this one. So this one's more about categorizing your stocks and having an investing checklist. So Peter Lynch, he mentions there's 6 type of stocks that you can invest in. But the reason he's categorizing into these 6 stocks is to, I guess, help you distinguish the different types of companies, but also acts as a tool for you to make better investment decisions. And the 6 that he mentioned was, first one was a slow grower. So these tend to be typically large. They're more mature companies, and they're expected to grow around the GDP rates, and they pay dividends. So if I bring it back to the ASX, you're probably looking at your banks potentially. And so these are the ones that pay dividends, and they're slow growers, but I guess a lot of Australians like to hold them because of the dividends. Secondly, you've got your medium growers, which he calls the stalwarts. And these are not the agile climbers. They're faster than the slow growers, but they're probably growing around the 10 to 12% annual growth. They're good, but they're not spectacular. In the book, he mentions a few examples like Coca-Cola, for instance, Procter & Gamble. In Australia, I'll probably say towards CSL. You probably agree, Scott?
Nice. Yeah, good one.
Yeah. The third one he's mentioned about is fast growers. That's a particular space that I'm really interested in. So these tend to be a bit more smaller. They're aggressive. They're new enterprises that grow 20 to 25%. In my view, I think this is the land of the 10 to 100 baggers. But these are younger companies, so they do pose a bit more higher risk. Then he goes and brings it towards your cyclicals. So these are the ones that rise and fall with the economy. So if there's a downturn, you'll expect lower returns. If there's an upturn, you expect higher returns. So I think these companies can include your auto industry, your airlines, your steel or chemical, for instance.
Building materials.
The fifth one he mentioned was, correct. The fifth one he mentioned was around turnarounds. And so these are like the battered companies that make up the lost ground very quickly. I'm trying to think of a recent example here, Scott. Maybe WiseTech?
I just wanted to bow on it. I don't mind that. I'm trying to think of it myself out there. There's plenty there. Pacific Brands, for those who have a longer memory, that the underwear and clothing maker was a turnaround that we managed to do okay on. Yeah, those businesses that have a temporary kind of falls from grace, but then manage to find their way back. It's difficult, right? Because on one hand, you want a turnaround's a great opportunity if you can get it. On the other hand, I think to mention Warren Buffett, because I should mention him at least once more, he said the problem with turnarounds is they seldom turn. And I guess that's the risk, right? Is you hope they turn around, but maybe they don't.
Yep. The last one is an asset play. So these tend to sit on, these are companies that sit on, I guess, something valuable. It can be as simple as cash, but it could be as like real estate. So you could be investing in your real estate investment trusts. Another colleague of mine mentioned about Crown being that hidden real estate piece of the valuation in this company. Yeah. But these are the 6 categories that Lynch has identified, and he said that this will definitely help, or it's helped him develop the story for him to monitor his stocks or monitor his companies going forward. And if I circle this back or link this back to the other point where I mentioned having an investing checklist, he's got an investing checklist for all these categories, but some of them are distilled and have very similar characteristics. And I think the takeaway here is that once you've identified the company and what category it belongs in, and you have your own investing checklist, because there's so much data out there, there's so much information, you can't possibly go through everything. So having that checklist, you can be focused on what's important. And that's really helped me in my investing journey. And it's helped me build my own checklist going forward when I look for, I guess, new screens or new stocks.
I love it, but I think it's really important. Checklists are a bit of a double-edged sword for me. You never want to be too prescriptive because not every company meets every test, or maybe there's things you otherwise need to consider. But particularly for newer investors, or as you're developing, as you say, an investment style, those checklists are super, super valuable, right? They're just a nice little touchstone because if you're not haven't been investing longer, if you have been, they're a reminder of things that can be important that maybe you're overlooking, or maybe you haven't thought about for a while, or maybe apply, as you say, to certain categories of companies. And that's why I think it's an immensely valuable part, both the categorization of the companies and the checklist you might use, just to kind of get the kind of creative juices flowing. If you're coming to investing, I can imagine plenty of people who start and go, all right, so I'm investing. I put my money in my brokerage account. Now what do I do? Now where do I look for ideas? How do I think about a company? How do I know whether Woolworths is worth buying, or CSL, or Telstra, or whatever company you want to choose, WiseTech? Are they businesses that I want to buy now? All of those things, everything from buying what you know through the checklist and that kind of stuff. It's a really, really important, really foundational way, as I said, to get yourself probably from 0 to, I don't know, 3, 4, 5 out of 10 reasonably quickly. There's no substitute for experience. There's no substitute for original thinking. But getting up to speed, it's almost like the uni degree before you go out into the workforce and kind of start learning for yourself. It's a really, really fantastic book, mate. I'm really super glad you brought it up, because One Up on Wall Street, I think, is absolutely one of the investing classics. It's one of the very, very best books. I can't imagine an excuse for saying, it's not my investing, so I'm not going to read it. It is just so valuable and so useful. If you haven't yet, viewers, take Benny's advice. Don't take my advice. Take Benny's advice, because Benny knows these things. Check out One Up on Wall Street by Peter Lynch. Exactly. That's right. I'm saying you should do it. We're saying, generally speaking, it's a good idea. He's also written a second book called Beating the Street. I might try and twist your arm and talk about Beating the Street at some future point, Benny. But start with One Up on Wall Street, fools. Check that one out. And then we'll come back next week, because we'll be bringing you yet another in this series of our favorite investment books. Benny, thanks again for joining me.
No, thanks for having me. Appreciate it, Scott.
And thanks for watching, viewers. Until next time, Fool on.